mathematical first point, and first point means that the exchange rate of currencies are equal. But if the demand is more than the supply, for example, the Pakistani people need the mark currency in high demand. Then what will happen? Like you are seeing in the R2, the demand is more than the supply. So what will happen? It will the currency rate amongst mark and rupees will change. The mark will be charged high. It will be at a premium rate. What is the premium rate? When the rate of the currency is higher than our home currency. That is called premium rate. So, for example, the mark 1 will be equal to 20 rupees. And if it is at par value, then mark 1 will be equal to 1 rupee. But when the supply of a currency is more than the demand of the currency, what will the result? The result will be like the R3 curve is showing that the supply is less and the demand is less and the supply is more. It will lead to discount rate, not discount par. Discount par means that the currency will be devalued against the currency of the other country. For example, 20 marks will be equal to 1. That means the discount rate. After discussing that the evaluation of rates, that how rates are fixed, I will have to discuss with you the exchange control. First of all, I would like to explain what the exchange control is. Exchange control is a straight regulation excluding the free play of the economic forces from the free play of the foreign exchanges market. Exchange control means that exchange rates are fixed. Foreign exchange is controlled by the government, the state bank, or the investor. Why? There are certain models behind this, which I will discuss later on this topic. But how the government, how the state bank, how they control the foreign exchange, they are controlling these things by 3 methods. First is fixing rates. In fixing rates, what normally they do, the government fixes the foreign currency rate for your own currency. For example, the dollar is fixed for rupees 80. It will never change. So this is fixing rate. Next is surrendering forex to state bank. Surrendering forex to state bank, it means that, for example, our investors are investing abroad. When they earn, they will receive the dividend in the form of, for example, they have invested in UK. They will receive the dividends in dollars. According to this policy, they are bound to deposit their dollars with the state bank, and the state bank will pay equivalent amount in rupees to them. They are not liable to use dollars in their home currency. According to the third policy, that is official rate or exchange pegging. What is exchange pegging? If the motive of the government or the motive of the state bank is to overvalue their currency, then they fixes the rates of the currencies, like the foreign currency rate is fixed downward. Foreign currency rate is fixed downward, and your home currency rate is fixed a little bit upward than the foreign currency. There is also called exchange pegging up, and vice versa. When the government wants to devalue its currency, so the point arises in your mind that why a government wants to devalue its currency. The government wants to devalue its currency to attract the foreign investor to your own country. That's why they devalue their currency. For example, like nowadays, the Pakistan is devaluing its rupee. That they want to attract the U.S. investors here to invest in Pakistan. So they devalue. The exchange rate is fixed below the level of par. So that is also called exchange pegging down. Objective of exchange control. That I have told you that I will discuss with you later that why government controls the exchange. So these are the points that why a government or a state bank wants to control the rates of exchange. First one is to correct the adverse balance of payments. First of all, I would like to discuss with you that what is adverse balance of payment. Adverse balance of payment means that, for example, we are unable to pay the debts of the other country. We we do not have such foreign currency to pay the debt of the other country. If we are taking the debt in dollars, we will have to repay them in dollars. So, making it possible that we must have as much dollars to pay it to the creditor country. That's why government wants to control the trade rate. The second one is to conserve the foreign exchange. Conserve the foreign exchange means forex is also foreign exchange. Forex is also controlled by a country for conserving its hard-earned foreign exchange. What is hard-earned foreign exchange? Hard-earned foreign exchange. This word means that if I have a lot of Afghani dollar, then I am a hard-earned country for Afghanistan. For example, if one country is having more currency of a foreign country, for example, Pakistan is having more currency of Afghanistan, then Pakistan becomes a hard foreign exchange nation for Afghanistan. It can anytime reduce the currency of Afghanistan. It can even if they want to increase the currency rate of Afghanistan, they will collect it more. But if they want to reduce this currency rate, they will supply the Afghani dollars more because they have stocked a lot of their currency. To protect the home industry, there is also a motive behind controlling the foreign exchange rate to protect the home industry. For example, take an example that Honda is manufacturing motorbikes here, and China is also providing motorbikes in the international market. For example, the motorbikes of China are costing very low, and the people will be attracted towards them. And what is the result? The result will be that our home companies will go in decline. So that's why the government wants to protect them. So they use the three tools which I have discussed earlier: that fixing rates, that imposing taxes upon exports, imports, etc. They control this by that to protect their home industry. To stabilize the exchange rate. If a country's currency is going downward, then the government or state bank of a government wants to control it. They want to stabilize their currency. That's why their objective to control the foreign exchange rates. That's why they are placing hurdles in the way of exchange rate. To prevent the flight of capital abroad. What does it mean? It means that some of our home investors, they are feeling that the interest rates, they are comparing the interest rates of the home country and the other countries. So definitely they will be attracted towards the interest rates of the foreigners because there the interest rates are very high. So they will try to invest in those countries. Our home investors will try to invest in the foreign countries. So with a view to discourage them in investing in foreign countries and moving their trend towards the home industry, that's why they are putting hurdles in the way of a foreign exchange and they are moving them towards their home industry. Next. To check the import of non-essential items. Exchange control is also used to check the import of non-essential and harmful goods like bombs and weapons. Source of income. In multiple exchange rates, the rate system, if the selling rates of the foreign exchange are higher than the buying rate, the difference between the two rates grows and income for the states, generates an income for the states. For example, the government fixes the rates among two currencies. For example, not in currencies, but in the process of buying and selling. In the process of buying and selling, it fixes the rate. For example, the government fixes that the money exchanger will have to buy their foreign currency, for example, a US dollar at rupees 80, and they will have to sell it on 81. So the difference among 80 and 81, this 1 rupee generates the income for the home country. So with a view to generate the income for the home country, the government is trying to put hurdles and just controlling the exchange. Important for plain. What does it mean? It means that the dealing of foreign exchange provides us some past facts and figures. By these facts and figures, these past facts and figures, we are able to plan for our future. So these facts and figures of exchanges are used for the future planning. That's why the government is trying to control the foreign exchange. Objectives of exchange. We are discussing objectives of exchange control, and other one is overvaluation. I have already discussed it, but I would like to discuss it again. That is exchange pegging up and exchange pegging down. If the country wants to raise its currency versus another currency, then it fixes a low rate, and that is called exchange pegging up. And if it wants to reduce its currency against another currency, against a foreign currency, it reduces the exchange rate. For what? For attracting the external investor towards the home country. Undervaluation. Thank you very much. If you have any question in your mind, let me know. Thank you very much.